Good afternoon, ladies and gentlemen, and welcome to the Solid State results presentation. We have previously played an introductory video as part of this presentation, but we're not going to do it this time. We've done it a few times. For newcomers to Solid State, can I point you to the introductory video and research portal on the Solid State Group website, as well as the appendices to this presentation, which will be available to revisit after the session. And if you would like any further information, please do contact us at solidstate@walbrookpr.com. Before we begin, we would like to submit the following poll, which you'll see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in via solidstate@walbrookpr.com. The company may not be able to answer every question it receives during the presentation. However, the company will review all questions submitted today and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we'd like to remind you that this presentation is being recorded. I'd now like to hand you over to Chief Executive Gary Marsh, Group Finance Director Peter James, and Matthew Richards, Managing Director of the Systems Division. Gentlemen.
Thanks, Tom. I'd like to welcome our shareholders and those of you that are new to Solid State. I hope you find the presentation informative, and we welcome your feedback following the meeting. Peter, Matthew and I look forward to answering your questions at the end of the presentation. The continued execution of our strategy has enabled us to deliver record revenue in the period, up 51% despite the well-publicised supply chain constraints and the geopolitical backdrop. This in turn has driven record adjusted EPS, increasing 39%. And following a full year dividend increase last year of 22%, the interim dividend will rise a further 4% in February. In H1, we've seen record order intake across our target markets, which in turn translated into a record open order book of over £112 million at the half year. Pleasingly, this momentum has continued into H2, with November closing up a further 5%. In this period, we made great strides in developing one of the 4 pillars of our strategy, namely internationalisation of the group, acquiring Custom Power in the USA in early August through an oversubscribed fundraise at £10.25. This acquisition significantly expands the power business unit in our systems division, an area we believe has considerable potential for growth over the medium term. Later, we'll give you an update on Custom Power and that acquisition 4 months in. Group development is driven by a combination of acquisitive and organic growth, and the work that began with our customers and suppliers as long ago as the late summer of 2020, when we saw the first signs of looming supply constraints, is now converting from the bookings phase into sales, resulting in a 31% organic revenue growth in the first 6 months of the year. The benefit of a components division within the group and the semiconductor market intelligence it can share across the group has been invaluable. A further pillar of our strategy is talent development, and here we're continuing to invest in our industry-leading team. Finally, we'll give some colour on other CapEx investments that we're making that help improve productivity, but importantly broaden the range of capabilities we can offer our customers. So for those of you not familiar with Solid State, this is our divisional structure, including our latest acquisition, Custom Power. Custom Power forms part of our systems division, led by Matthew Richards as Divisional Managing Director. Matthew, as you've seen, is joining us today, with the components division led by its Divisional Managing Director, John McMichael. The brand Custom Power is valuable to the group, and we're considering adopting this for our enlarged power business unit. As such, we've registered the name in the UK, and we've also registered the domain name custompower.co.uk. I'll now hand you over to Peter, who will talk you through our first half year financial highlights.
Thanks, Gary. First up, a couple of charts here, and yeah, the revenue growth, as Gary said, has been very pleasing, and that's been across both divisions. Our systems division, as Gary talked to, has benefited from just over a month and a half of the acquisition of Custom Power, and that's added about 3.4 million of revenue into the period. As we've reported in the past, we also have a natural hedge in terms of US dollars. So we match our US dollar purchases with US dollar sales. This has given us a pretty significant benefit in revenue terms in the first half of 4.4 million. However, because of that natural hedge, it does conversely depress our gross margin percentage with the additional revenue, albeit the absolute margin is still protected. So as Gary talked to, organic revenue growth of 31% is really very pleasing, and that reflects the hard work that Matthew and John's teams have put in over the last 18 months to manage the supply chain challenges we've talked to on previous investor meet presentations. In terms of gross margins, there you can see the third line where gross margins are down 110 basis points. However, those FX headwinds cause about a 2.7%, 270 basis point headwind. So on a like-for-like constant currency basis, underlying margins are up just over 150 basis points. That reflects the enhanced value add and technology we've had from the acquisitions and a richening mix of sales. So on the component side, we've added Willow Technologies in last year, and that's helped richen the mix with more own brand product. And on the system side, both Active Silicon and Custom Power add advanced technology, which helps richen the mix in terms of margins as well. Adjusted operating margin, 9.3%, up on the prior year, 70 basis points. That benefits from the operational gearing, where we've seen the growth in revenue translate. However, albeit there is some benefit from the fact that recruitment of talent has been challenging. Pleasingly, we've been able to add people to the team in the latter part of this period. However, we haven't had a full period of cost of those recruits. Growth means going forward, actually we've created a rod for our own back, as we're no longer going to be eligible for the SME R&D tax credit scheme. So the profit before tax improvement is up 60%. Whereas if you look at the profit after tax, you can see it's up still significantly at 46%, but not at the same level as the before tax. And that's because we're going to be only eligible for the large company scheme. Actually, in terms of timing, we couldn't possibly have timed it better, because the Chancellor just in his last budget announced that he's improving the large company scheme. So actually, the impact is somewhat reduced. That translates into record EPS in the first half of 45.3 pence. If we look at the full year expectations with the analysts, they're just shy of 80 pence, which is up 13% on the prior year actuals. Coming onto the balance sheet, I'll spend a little more time on the balance sheet than I have in previous presentations, because there's some pretty significant changes with the addition of Custom Power. So our acquisition accounting, our provisional acquisition accounting, reflected in here, reflects the Custom Power balance sheet. So we've added in working capital of $6.5 million, PPE and intangibles of $9.5 million, and deferred tax of about $500,000. So overall, we've added in provisional goodwill of $27.5 million. So clearly, very significant changes in the balance sheet on the year end and the prior year half year. If we look at the net assets there, you can see the significant change from half year, from year end to half year, and that predominantly reflects the additional equity raised to fund the acquisition of Custom Power, 27 million, the retained profit for the period, and an FX gain where we've revalued those US dollar assets following the strengthening of the dollar in September. In terms of the funding, the other big factors you can see there are the Lloyds facility that we took on to part fund the acquisition, and the standby letters of credit where there's the cash on deposit. So you can see the cash and cash equivalents has increased very significantly as well to fund the deferred elements of that consideration. So if we move on to the sort of the underlying trading balance sheet side of things, we've seen significant investment in inventory, which is up 3.4 million on a like-for-like basis, and an increase in receivables with those extra revenues and billings. So we've invested pretty significantly in working capital. If we look net debt, there's been an increase in net debt, which is largely driven by the increase in deferred consideration. The 14.4 million is made up of two key elements, 2 million related to the final payments for Active Silicon, and the balance relates to the acquisition of Custom Power. The deferred consideration is $10 million, and then there's contingent consideration of $5 million on top of that. And the bank facilities, the term loan of 13 million is fully drawn, and we retain our RCF, which is partially drawn at the half-year period. So moving on to the cash flow, obviously you can see the impact in terms of working capital investment. So our strong cash profits have been invested in our working capital to secure that organic growth in the period. The two big numbers on the cash flow clearly relate to the equity raise of 27 million we talked to previously, and the payments for acquisitions. There's 25 million related to the initial payment for Custom Power, and just over 4 million related to the deferred consideration for the previous acquisitions of Active Silicon and Willow Technologies. Here on this slide also you can see the increased finance charges associated with taking that debt on. So 300,000 in the first half. The full year consensus is just over £1 million because obviously we took that debt on towards the end of the period. Our cash generation from the second half we will look to use to pay down that debt and afford us future flexibility in further investment, be that capital expenditure or future M&A as well. As Gary said on the opening slide, we maintain our progressive dividend policy, and our interim dividend is up 4% on the prior year. And across a 2-year period, if you look back to the full year dividend for 2021, that was 16p, and the consensus for the full year this year is 20p. So across the 2 years, the dividend growth will be 25%, which is pretty strong. I'll hand back to Gary to take you through the investment proposition.
Thanks, Pete. So what have we achieved over recent years? Significant growth in revenues and profits by executing on our strategy. Improving operating margins by approximately 200 basis points, which is a 1/3 improvement, with adjusted EPS reflecting close to 25% compound annual growth over the last 4 years. Over this time frame, we've delivered significant growth in total shareholder return through a combination of organic growth and strategic bolt-on M&A. Our ambition is to repeat the success to date. So what would that mean? In EPS, replicating that performance would double EPS from 70 to 140 pence. And in terms of return on investment for shareholders, that means at least a 20% compound annual growth rate in total shareholder return. So I'll move to our strategy now, especially for those that are new to the story. So it has 4 key elements. Firstly, broadening our technology and product portfolio. Recent examples here include Active Silicon's range of imaging products, including autofocus zoom cameras that you can see there on the top right of the slide, with Custom Power expanding our battery management systems. Next is internationalization of the group. Last financial year, the Active Silicon and Willow acquisitions helped grow the international sales from 30 to 38% of total revenue. Custom Power has a strong position in the US market with tier 1 OEM customers, and this will bring us to almost 50%. Own brand products. Here, the group continues to build on our optical sensor range for medical applications. Our electromechanical relays and contactors from the recent Willow acquisitions are used in energy storage and EV applications, and Custom Power now introduces high reliability, lightweight battery pack solutions for drones. And finally, investment and development of our talent, both through recruitment and acquisition. This last quadrant, I think, above all, has been key to us delivering on our growth ambitions. I'll now hand you over to Matthew, who'll talk you through a couple of slides. Thanks, Matthew.
Thanks, Gary. So some detail on that business model and working from the top left. That extensive industry experience, both technical and commercial, has enabled us to successfully manage those macroeconomic challenges of recent years and really respond swiftly to fast-moving threats and indeed opportunities. Our specialist technology supports a diverse range of market sectors, giving the group resilience. And this has been further enhanced with those recent acquisitions and really does underpin our business performance. The business remains agile and proactive and really able to respond to new and existing customer requirements. It's that proactive element that we're really focusing on now, reaching out to customers in our core markets. Over many years, we've built strong key customer relationships and are now securing larger contracts as our product range expands, and that's really evolving our proposition with true system engineering and value add. We have an extensive supply base, and that allows the group to design in the best technology for a given application and giving our customers the options, particularly as we're managing through the supply chain challenges which have been discussed and will continue to be an issue for a period to come. So we bring all these technologies together across the group to provide engineered solutions. And we've had some examples of late, the Be Hero and Transport for London projects that we announced through RNS Reach, and most recently the significant NATO contract awards. Really adding value at every opportunity is what we're striving for. Oh, thanks, Pete. So in terms of investment, we're continuing to invest in technology and to develop our capabilities, enhancing our IP and our know-how. This investment is really enabling us to deliver more integrated customer solutions that allow us to differentiate from our competitors, and continuing to drive productivity and margin improvement. In terms of these images here at our Redditch facility, it includes top left our new EMC, our electromagnetic compatibility test chamber, which has just been commissioned, actually at the time of our preliminary results. And we've recently been testing battery product in that chamber, as well as computer hardware. Post-period, we've added additional equipment that will allow us to perform Tempest testing. That's a technology that identifies compromising emissions and vulnerabilities from computer hardware, so enabling in-house security products to be built and tested. The equipment to the top far right in this image is our new wire bonder at the Crewe Kern facility in Somerset. That was ordered in the period and is now up and running and allows semi-automated battery pack assembly. The current pack in build, the small green image there, uses some 1,700 individual wire bonds. Now that in a conventional design, it would be 1/3 fewer, something like 600, one third of that, no, it's something like 600 welds. So that 1,700, that's giving improved reliability and improved quality, whilst operating much quicker, in this case, some 4 times quicker than a conventional welding. That's it, driving efficiency, of course. The image there is showing a battery that's in an early phase of its build. The finished product is actually the one that's in test in the chamber to the left, the small grey box, hard to see, but bringing the group together, cross-site working in action there. Along the bottom are the external images and internal shot of our new Custom Power facility, and we've got some exciting ideas for investment at that site. And then finally, in the centre is our Weymouth facility, where we've continued to invest in our Class 7 clean room with the recent installation of a new semi-automated die bonder technology that's improving throughput, reducing waste, and consequently improving efficiencies again. And it's demonstrating our advanced capability, opening up opportunity with tier one customers, larger projects, and those that have visited that facility have commented how it's separating us from our competition. So thanks again, Peter. A snapshot of the first few months then of Custom Power that comes under my responsibility. Lot on the slide. No apologies for that. Lots of technology to talk about. Capabilities for drones and low temperature battery packs. We're using Mylar heating technology, lightweight insulating materials, foam and aerogels, and we've got embedded temperature sensors and remote diagnostics. Little hard to see, but the image with the green and red is that a tool for the engineers to interrogate a battery pack to look at its temperature of the individual cells or the packs, the balancing of the cells, the charging status. So that's a capability that we just simply didn't previously have, and again really distinguishes and separates us from competition. Incorporating lightweight materials, Kevlar and advanced plastics, again for drone applications of different market needs. Team-wise, we've got some good teamwork ongoing. We're taking care particularly on the ITAR and export control matters, something we've got experience on. And in just generally speaking, the team cross-pollinating with having people visit the facility, and not least myself, but others too, over in the US. And also we have the key engineering lead coming from the US to the UK for some collaboration discussions. Already had some good team meetings already, but looking forward to having them come over to the UK. Supply chain, the component issues have been a challenge for both sides of the water for battery production, but we've yet to benefit from our component division expertise, and we're looking to bring that to bear along with some obsolescence management, and we're also looking at some options for dual sourcing of supply of component supply. Again, bringing our skills within the group to bear. Had some good wins actually with the purchasing team already. The US team actually helped us source a particularly advanced foam material for a UK project, which was very difficult for us to buy in the UK, and the guys in the US sourced that for us, and really helped the key customer. Order book, absolutely seeing solid demand, but really positively, margins are also trending in the right direction as we focus on the high value packs where our engineering expertise is recognized and valued. Market-wise, generally across our power business, we're seeing some recovery in the energy market actually. We've got good discussions going on from UK customers and US customers looking for production at the respective sites, vice versa. So that's something Gary's talked about, bringing battery packs are heavy, and therefore if we can build them close to our customers, that's a benefit and advantage. So in terms of markets, absolutely strong in defence, but not exclusively defence, other applications as well for drones, and generally robotics and medical devices. So look forward to any questions you've got, but I'm going to hand back to Gary now.
Thanks, Matthew. Our focus on government funded markets and those with high barrier to entry requiring accreditations has really proved their worth in this first half. Our order intake continues to be strong in the defence sector, where the instability in Ukraine has clearly focused investment. Adoption of new industrial technologies through organic product development and the recent acquisitions of Active Silicon, Willow Technologies and now Custom Power, combined with our strategic CapEx investment, will drive future growth across both divisions. Our open order book closed at record levels at the end of September, and pleasingly that momentum has continued into the second half, increasing a further 5% to just under £118 million by the end of November. The strong start to the year both in terms of the sales and recently announced contract wins, has underpinned the board's confidence to upgrade FY23 and FY24 expectations. In the next phase of our strategy development, we'll be setting out our growth ambitions. Key market drivers for the adoption of technology means we'll be setting goals now to 2030. This will align with our aspiration to exceed the performance we've achieved over the last 5 years, being the doubling of EPS and greater than 20% compound annual growth in total shareholder return. So that concludes the presentation, and we're happy to take any questions. I see quite a number have come in, so that's good to see. So I'll let Tom take care from here.
Yep, thank you, Gary. Thank you, Pete. Matthew. Now, if we could turn to the questions, we had a number of questions that were pre-submitted, which we'll come to, but please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. Additionally, your feedback is important to the company, so immediately after the presentation has ended, you will be redirected for the opportunity to provide feedback. Let's start with one on supply chain, if we could, and it's probably one that you may start on, Gary, because I know supply chain's been an ongoing theme for the past few results announcements. What supply chain challenges have you faced in achieving 30% like-for-like revenue growth?
Good question. I think that the first thing to probably state is, we've got an experienced senior management team. We've been through these cycles several times before. For me, until this time, probably the worst one was in 99-2000 when the dot-com bubble burst. But in my career, the one we're currently going through is probably the worst I've seen. But so we've got experience in managing that, and I spoke about that earlier in the presentation. It's important we engage with both our customers and suppliers, as we could see this coming down the track. I don't like using the word unique. I think we could be careful with that, but I think we're one of probably very few companies on the AIM market that has the benefit of a components business within the group, and that semiconductor market intelligence I mentioned in the slides, I think it's really proved value here. Engaging with customers and suppliers early, so getting those bookings, talking to suppliers, getting the orders in place, often on a year's delivery. So that inventory build has happened. We're now in that phase, as I said, of pulling that through to sales, and that's hence we've achieved that 30% organic growth rate. The job doesn't end there. The other side of that coin is to manage the inventory downwards as lead times return more to normality. But again, we've got experience there, and the team are very much focused on that management of inventory as the market begins to normalise. Probably for us, the latter part of next year. So, Pete, you want to add anything to that?
No, I think that's a very comprehensive answer you've given there, Gary. I guess the only thing that's probably really pertinent is the strength of our balance sheet and the support of our shareholders and bank has enabled us to make those strategic investments in partnership with our customers. As we've built our order book, we've been able to place order cover on suppliers, mirrored with order cover from customers, and that not all of our competitors are in that position, and I certainly think that has helped us commercially.
Great. Okay, that's comprehensive. Thank you. Now, one that we might put to Matthew in the first instance, if we could, because it's got a custom power element to it. But how has your structural growth market strategy changed with the acquisition of custom power and a greater exposure to the US?
Yeah, thank you. As a business, certainly defence has featured significantly in our business in the round, but not particularly in our power division traditionally. So the acquisition of Custom Power, although they've got a blend, they have some really strong blue chip relationships with some really key defence contractors and prime contractors. So that would certainly be a change. but not exclusively defence. They're in the medical customer base, agri-tech, and some other tech as well. So I would say that generally it's going to see a growth in our defence activity, and that's just some of the geopolitical status. It's hardly surprising, but what it will allow us to do is get some exposure to those big US defence primes that we haven't previously worked with, but also some important medical clients too.
Great. Okay. If we could just stick with custom power for a minute, we've got a question from Michael. Michael says, great results. Have the management team from your acquisition of custom power been retained, and do they have any leaving restrictions?
Really let Gary answer that.
Yes, they have been retained. We have in the UK a CSOP scheme, a share option scheme for our senior leadership team. We're working on that. I was over with Matthew a couple of weeks ago to Custom Power, and we're already working on a similar scheme, US based, for the senior leadership team to incentivise them for growth over the coming years. So that's something to be worked on. There are certain restrictions on some of the employees, but the focus really, I was very pleased, visits you've made, with the engagement of that team there's excellent. That came out in due diligence. I mean, culture is a very important part of our due diligence when we look to acquire a business, and that's great when you're about to acquire. It's very different when you actually turn up and you own the thing. But I was really pleased with the engagement of the team there. Came away very happy. During those first visits.
If I may quickly just reinforce that, the hearts and minds. I've had the pleasure on a chilly day like today to spend some time out there, and I'll be spending more time. But we really focused on that, the hearts and minds, and they're excited and they're in for the long haul. So I'm very pleased to say they're staying, and they are motivated to do so.
Great. Okay. On the same custom power theme, Scott says, great job. As international sales grow, do you think there will be a need for a US-based board member?
Shall I grab that one, Gary, first off, and you can add some thoughts? So we've already announced that we are looking to recruit an additional non-executive director, and as part of that process, we will look at candidates that have US experience. I don't think they need to be US based personally. For me, it's about getting the right blend of skills, and certainly US experience would be a valuable part of that candidate if we can find that suitable candidate. But I don't think it's a mandatory thing, but it certainly would be a nice to have for me.
Great. Okay. Anything to add there, Gary, or does that?
No, I think Pete's covered it there.
Great. Okay, we've got some financials questions now. Mark, thanks for your question. Excellent results, thank you, says Mark. Could you please comment on the low operating cash flow, in particular the increases in inventories, brackets from the acquisition question, and trade and other receivables, and the much smaller increase in trade and other payables?
Of course. So, yeah, as I said on the finance slides, we generated good cash profits in this period, but against the backdrop of just over 50% growth in revenue, we absolutely have seen an increase in working capital. So the increase in receivables reflects the strong billings we've had in the first half. The increase in inventories actually is broadly pro rata with the increase in open order book. So if you look at the inventories as a ratio to open order book, it's almost exactly the same ratio at the half year end to the year end. As Gary's talked about, with the extended lead times we're seeing, it is higher than we've seen pre the shortages and pre-pandemic in terms of a ratio, but actually it's pretty much stable now and reflecting that growth in order cover from customers, and that puts us in a good position for the second half. In terms of payables, unfortunately our payables we're not in a position where our suppliers in Asia are as accommodating as we need to be to our tier one customers in the West. When you're dealing with Chinese and Asian suppliers, typically they want payment either up front or very soon afterwards. And when the product comes on a boat, the lead times can be very long. So you don't see a benefit in payables that you do, where you see the investment in inventory and debtors.
Okay, great. Jeremy, the two EPS questions actually. So Jeremy asks, why is consensus EPS forecast for the second half lower at 35p than was delivered for the first half at 45p?
So there's a couple of factors to this. The key one is a bit of maths around how EPS is calculated. So because you calculate EPS based on your weighted average number of shares, the shares we issued for the fundraising are only in place for a month and a half, 2 months of this period, whereas for the second half they will be there for 8 months. So the weighted average shares in issue calculation skews the calculation in the first half's favour. And also, we have absolutely had a very strong first half where the inventories we secured ahead of the first half has enabled us to get product out the door effectively. And that's delivered strong performance in the first half. We're continuing to be cautious because supply chains continue to be challenging as we go into the second half.
Okay. And from Michael, having doubled the EPS over the last 5 years, what should shareholders expect next? And I know you referred to that briefly, Gary, in your presentation.
I think we exceeded it. I mean, we got to 70 pence. We started at 30 5 years ago, and I recall getting a few sort of raised eyebrows at the thought of doubling EPS in that period. But pleasingly, that ambition, that stretch goal we achieved. So it would be 70 to 140 pence.
Right. Okay.
I think Gary, we've also really started to focus on total shareholder return, as you said in your slide, and really trying to ensure that we maintain that as well over the period ahead.
Okay, super, thank you. So we've got a couple of questions on acquisitions, but I'm actually just going to backtrack very quickly because one's come in and around the supply chain and order book, which, if I might ask, Scott has asked, do you get a sense that any customers may have forward ordered to avoid future supply chain issues?
I think there has been some of that, certainly, but there is the new wafer fabs that are coming on stream tend to be the new smaller geometry fabs, so smaller geometry wafers. So what we're seeing is there's still going to be issues with supply chain. I think probably, as far as we can see, going through the rest of this financial year, and into the first half of our next financial year, hopefully easing in H2 next year. The semiconductors we use in our products are industrial grade by and large, so they aren't particularly affected by that. It will take a while for that to transition through to improve lead time. So yes, certainly some buying ahead, but I think people are still having to manage those very long lead times. Certainly in cells, on the battery side, there are still very long lead times there, and that will continue.
I guess, Gary, what I would add is, if we look pre-COVID, which was what I would call more normal times, our order book visibility was typically about 12 months as a business, and I think that was sort of the long-term norm that the group had seen. When COVID first hit, the order book visibility really shrank down to probably 6 months. As Gary said in his opening couple of slides, we engaged with customers early 2020, pretty soon after COVID, and we started to see that order visibility increase as we foresaw the shortages. When we got to year end, we were talking to you about an 18-month visibility, which is probably where we are at the moment as well. I think it's fair to say we do absolutely anticipate, as supply chains normalise, we'll probably hopefully get back to a more normal state of 12 months worth of visibility. But at some point, as supply chains normalise, there will be a shortening of order visibility. We anticipate back towards that sort of historic norm of 12 months.
Great. Okay, super. Right. So we've got 2 questions now on acquisitions. Sam asks, you reference in your results that you continue to be acquisitive. What are you looking for and how would you look to finance them?
Okay, that's a good question. Yeah, it was part of our strategy is combination organic growth and growth by acquisition. So we recognise it was a large acquisition we made in Custom Power. We need to integrate that business. So a lot of focus there, but that work in looking at new acquisitions continue. Really quite fussy on that. We turn a lot away. But we've got some good pipeline on own brand products. We're looking at developing our business in the European Union, especially on the component side of the business, but also other acquisition opportunities emerging in the US as well. So they're probably the three areas we'd look at. And as we've done previously, it will be size dependent on the demands for those businesses, but we've always looked to a combination of debt finance on that, and that's why we're on the public markets to fund it through a fundraiser. We can, as very successfully, quite a difficult market we did there, but I think that will be during next year. Certainly not in the near term. As I said, we're very much at early phases of research on businesses.
I guess the thing I would add in terms of financing, we're currently, the expectations in terms of EBITDA to net debt just over 1-to-1 at year end. So the consensus expectations for net debt is just under 14 million, with EBITDA about 13 million, so just over 1-to-1. As we look to continue to pay debt down, that affords us more flexibility for some of the investments that Matthew talked about on the previous slide, or future M&A as we go into next year as well.
Super. Okay, and that leads us nicely on to the final question, which is, does there need to be a period of digestion before you consider any further M&A activity?
Yes. I think I covered that hopefully in the previous answer.
Yeah. Okay.
I guess the one thing I would add is the management team has really grown over the last sort of 2-3 years, and M&A has been a real big benefit to that. Whether it be Custom Power, the management team. There was a question earlier that Gary's talked to. They're really very valuable to us. They've got some really excellent engineers that have really bolstered our capability. Active Silicon, similarly, have some really fantastic technology leads and engineering in their team. And Willow, their expertise around electromechanical products have really added to our components division. So M&A is not only about technology, it's also about acquiring the talent. And as Gary said, one of the things that is really important through the diligence is making sure we evaluate culture, fit, and individuals' capabilities, because we've done and benefited very significantly from the people that have joined through the acquisitions we've done in recent times.
Yeah, great. Okay, that's a less obvious but very positive way to finish. Great. Okay, well, look, thank you, Gary, Pete, Matthew, for updating investors today. Could I ask investors not to close this session, as you'll be automatically redirected for the opportunity to provide your feedback. If anyone has further questions or would like additional information on Solid State, please do get in contact via solidstate@walbrookpr.com. Many thanks for attending, and we look forward to updating you again soon.
Thank you.
Thank you.
Thanks.
Goodbye.
Thanks all. Bye-bye.